Hey Rick, how you doing?
I'm great, Sharon. How are you?
Good, good. Going out and shoveling snow today?
Oh, can't wait.
Before
Have you
you
guys
go, I
been
got a
hitting it
question
hard
for you.
in Oshawa? Or
Yeah, I'm not touching it. I'll leave it. I'll leave it for Josh.
there
Um,
you go.
but before you go out and get into the snow, I got something I want to talk to you about. Um, I was thinking that, like we talk a lot about, mortgages, what type of mortgages to get, first time buyers and their needs are. Um, Looking at your bank options and looking at your broker options and what the differences are. But there is one thing that really doesn't get talked about that much. And that is when a mortgage is coming up for renewal. Now, I know how easy it is. They send you some paper in the mail. They got 5 post-it notes in the right places. Quite honestly, I mean, they're quite happy if you don't read it. Just go where the post-it notes are and initial and sign and drop it in the mail back. Or today we get an email by DocuSign or whatever, same thing. And it's all set up and I initial sign, send it back and I get a copy back to me. And that makes it seem really, really easy to do on a mortgage renewal.
Sure.
But based on the experience that we have on mortgages and the thousands that it can cost you or that it can save you depending on the type of mortgage that you take, what is the impact on a mortgage when it comes time for renewal? Like people often think that, well, I've done my mortgage, I've negotiated, now I'll just keep renewing it every 5 years, generally speaking. I'll renew it every 5 years. They just send it to me, I sign it, it's easy peasy, and we're good to go.
Yep.
Is there a challenge with that? Is that a wise thing to do? Are there things we should be looking for? What would you have to say to that?
Well, I would definitely recommend that you contact me and we can review what it is that they're offering you.
Yeah.
And we should compare it to what's available in the market for someone that is like yourself. I mean, obviously, there are going to be rates that you can look at online and so forth.
Yeah.
But it depends on what your mortgage was initially as to whether, like, you can't compare insured rates, for example, with the rates that they're offering you if you put down more than 20%, because getting that insurance protects the lender. So they're willing to usually offer you a better rate than would be available otherwise. But the lender hopes that you just renew because that's where they really start making profit, because they don't have to go to any of the underwriting expenses that they do when you first apply to the mortgage. And also they often aren't offering a very competitive rate.
That's it. Yep.
It's very unfortunate in that because of the new stress test, often you're stuck because where you qualified before for that mortgage, you're not qualified at this time. So you can't apply elsewhere and get approved because your income is no longer sufficient, even if you're making more money than you were when you first applied, because interest rates have increased and the stress tests have come in and all that stuff. But it's definitely worth having a conversation. Also, what term should you take? Should you go with variable or fixed or an adjustable rate mortgage? There's all sorts of options here.
How long you should take it?
Well, yeah, for sure. Because a lot of fixed rate mortgages do not make it to maturity, and there can be big penalties attached if you break your mortgage early.
Right.
So you really want to, if you want the security of a fixed rate, then you should be pretty confident that you're not gonna sell or have to break the mortgage early. If you're thinking of doing some sort of renovations or whatever, then or paying down debt, like this can be an excellent time to consolidate debt if you've got a lot of credit card debt or unsecured lines of credit. We can take a look. If you qualify, we can just do a refinance of your mortgage at that point. Because it's at maturity, there's no penalties. So that can be an excellent time to take money out of, like, take some equity out of your house for whatever reason, be that to pay down debt, to do some renovations, or maybe you want to consider making a big RSP contribution. You're not going to get a better rate usually than if it's secured by your house.
Right.
So
Right.
much cheaper than going to like getting an RSP loan from the bank usually.
Yeah.
So, but yes, I mean, it depends situationally, because of course, and often once you get that renewal letter, you have a long time before you have to accept it. So, you know, what's going to happen with, depending on what term you're looking at, if you're looking at a 5-year term versus a 3-year term, the yields on the 5-year bond rates will determine what rates are being offered. So you can sit there, you can always sign it before the deadline, but you can sit there and see what happens to 5-year bond yields, and maybe you can you know, get a better rate elsewhere. Or you know, if so you would sign an agent of record letter for me, and then I can communicate directly with the lender on your behalf and negotiate with the lender. Like maybe we can just say, look, this is a great client. They've got a really good credit rating. You know, they've got a secure job. They've never missed a payment. But they can go over to, you know, this other lender and, you know, save 20 basis points. And, you know, I'll have to advise them that that's what they should do if you can't match that rate. So it's like, okay, great. So now you just get a new offer. You sign that offer. You still don't have to do any extra work. But now your rate is comparable to the other lender. Sometimes they will, sometimes they can't, right? Like they don't necessarily always have that discretion, but it's worth trying.
Yeah. So basically, I mean, it's keeping in mind that just because you got your mortgage once, and you could have a 20 or 25-year amortization on it, life keeps happening, and it keeps changing, and the needs keep changing. So yes, there is an investment in your home, and if you need cash, it's there. And if you got, like, you know, if you're retiring in 2 years and you're going to move up north, you don't want to take a 5-year mortgage.
Definitely not.
Right. So and if you're wanting to refinance because you want to get a condo or something because your kid's going to college somewhere and you want to buy that condo so that they can have it while they're in university, you know, like there's some things there that would cost them greatly if they kept it at 5 years.
And one other thing I want to mention, Sharon, is a lot of people are going to be in for quite the sticker shock when their mortgage renews, because if, you know, they got their mortgage 3 years ago or 5 years ago, rate probably much lower when they got their mortgage. So they're going to see, you know, even if they don't make any changes, they're going to see their monthly payments go up quite a bit. There could be the opportunity. Refinancing doesn't necessarily mean that you have to take equity out of the property. You could stretch the amortization back out. So you could go to 25 or possibly even 30-year amortization to lower your payments to make it more manageable. So you're not, you know, completely mortgage poor and racking up credit card debt and all that sort of thing. But you don't want to do that after you sign the 5-year term renewal. You don't want to come back 6 months and be like, I'm so deep in debt, I'm going to have to sell the house and break the mortgage and pay all these penalties and, you know, go back to renting. It's like there could be an excellent opportunity when your mortgage is coming up for renewal. We could just look at doing a refinance and just stretching out the amortization to lower your payments back down. You can always increase your payment schedule down the road. You can usually pay up to an additional 20%. So, you know, it's, you have to keep in mind, even though mortgage rates are cheaper right now, it's still less than the rate of inflation. So it's essentially free money if you look at it that way. When you look at, you know, the real costs. So.
Now, do you have any, that's a good point. And do you have any tips for us on, you know, when people are coming up for renewal? So definitely to talk to you, in other words, because there's options, like you said, stretching out the mortgage. They don't have to feel trapped and absolutely have to sign at the current going rate in the same amortization period.
Refinancing, there's a very good, well, I mean, especially if you bought like 5 years ago, there's a very good chance you can refinance, because the requirement for refinancing is that you're going to have 20% of the equity. You can't go above 80% of the equity being financed when you're doing a refinance. But you also have to meet the GDS and sorry, I shouldn't use the gross debt service and total debt service requirements. You have to qualify for that when you're doing a refinance. But even if you don't currently qualify, like, it's going to be easier to qualify because we're stretching the amortization back out to as long as possible. But we could go to an alternative lender if necessary. They're more expensive interest rate wise, and they have some fees. But if you're not going to be able to carry the payments otherwise, it might still be worth it. So everyone's got their own individual situation. So all I could say is, call me and we'll take a look at it and see what can be done.
Yeah. I also had some clients, and I still have one right now, that just spoke to her yesterday, and even with the rates right now, like she's refinancing and looking at the equity. She's looking at a home with an apartment so that she can move into it and have a source of income, and then she's going to keep the other house and still rent it out as well.
Yeah, well, I mean, it's a great opportunity. If you've got the equity in your home, put it to work for you.
And you don't have the competition, so it's not driving the prices up, right? Like, so generally we can go in at that asking price. There is some bidding happening again now, but many of them we can still go in at that price or less. If it's priced right, then you can still pick it up at a really good price, and you're not getting the competition, so you're not driving up the price.
Well, I think now is a really great time to be a buyer, because it's the price you pay, that's locked in. That's not going to change. Interest rates are going to go up and they're going to go down in the future. It's impossible to predict exactly what's going to happen. But that's going to be constantly changing. But what you paid is what you paid. So, I'd say now is a better time to buy than, say, 3 or 4 years ago. Because
especially as a first-time buyer.
So it's, I mean, I could go on and on about, the first-time home buying and what the government could do to make it easier for people to qualify. I've got huge issues with the fact that the government has no problem with you paying $2,500 a month in rent, but we won't let you pay that on a mortgage payment.
And that is an issue. Generally, people are paying a lot more in rent than we will allow, and they're doing fine with it. It's not an issue for them, and yet we won't grant mortgages.
No, it's not fair. I understand when it's an insured mortgage, because the government is the insurer, so of course they have to. There's private insurers out there as well, but they have to have their criteria. But if you're putting 20% down, it should, no one tells you how much you can spend on your car, but the government comes in and says, "Oh, you're not allowed to do that." So if the lender's willing to lend it to you and it's not insured, then I don't see why it should be an issue. But
we can only hope for more reforms and root for it.
Unfortunately, the reforms are all going the other way.
Well, we'll just keep advising our clients how to make the best of the situation, just like with the mortgage renewal, right? So that they can save some money, or at least not cost them as much, and they can actually have peace of mind, rather than thinking that they must, when they sign again to renew, that their mortgage must go up because the interest rate is up. Not necessarily the case. They need to talk to us and find out.
Yeah. And as you were saying before about the opportunity of buying another place as a rental, there is a loophole I should mention, because normally you have to have 20% down in order to buy. But if you buy a new house and that becomes your principal residence, you can buy with as little as 5% down. Now, of course, you have to meet the CMHC guidelines of up to 5%, or as little as 5% down up to 500,000, and then it's 10% down up to the million. So, for example, 600,000 would be 35,000 as a down payment would be the minimum. you could do. But that can be a way where you turn your existing house into a rental and you don't have to have 20% down to become a landlord. So now you've got two properties, one of them which is an income property. And you know, if the new house you're buying into has a basement suite, then you've got two rentals on the go already, right? So
and a few years down the road, you can turn around and do the same thing again, and actually build quite a portfolio, and still buying homes and moving in at 5% down. At least we are still allowed to do that at this time, right? So that was actually something I had on my list to talk to you about at another time. But certainly, yeah, now that you've brought it up, I mean, it's a great way to build wealth because you're not going in with the 25% down. And it's kind of a rinse and repeat situation because you build the equity, take the money and get another property and move into it.
Well, I mean, the rental situation is crazy right now, at least in the GTA. Like people are paying insanely high amounts of rent. And it's just going to get worse because I think it was like 500,000 people they're planning on bringing in every year. And most people come to Toronto. So,
and imagine the rent's 23% higher this year than last year.
Yeah, and I don't see
where else do you see those kind of increases. And as a landlord, I mean, unfortunately, that is the market for tenants. For a landlord, there certainly can capitalize on that. And there's some big rents out there. There's not enough spaces, and they're forecasting that the rents will continue to increase because of the lack of housing. So where the demand is high, the value goes up, right? So it's certainly a great way to build a portfolio. And that's two great topics you covered today. We're going to have to share those out there separately so that we don't miss the benefit of both those. Two great conversations there.
What better time to buy than when prices are lower than they have been, and what you can get, what yield you can get is super high.
Yes, that's right. Yeah. Thank you, Rick. I appreciate your input, my friend. Go shovel your snow now.
Sorry, what's that?
I said you can go and shovel your snow now.
Yeah, thanks. Appreciate that.
Anytime. Take care.
I'm already having the warm beverage, so.
Yeah.
Thanks, Sharon.
Thank you.